the panic that tested a nation. It began with whispers drifting through crowded streets, the kind of rumors that tighten a city's pulse. Banks that once seemed unshakable were suddenly at the center of quiet doubt, and in a world held together by confidence, doubt was the most dangerous currency of all. To understand why this moment still holds power today, we need to return to an America growing faster than its systems could handle. New towns were rising. Railroads were stitching coasts together. Credit flowed with a speed the nation had never experienced. It felt like prosperity without limits. But hidden beneath the excitement was a fragile foundation, one built on speculation, uneven regulation, and trust stretched too thin. The panic didn't begin with a dramatic collapse. It began with hesitation. A few withdrawals here, a closed office there. Each small event chipped away at public confidence. And in a world without instant communication, uncertainty spread through letters, newspapers, and conversations whispered across dinner tables. People began to wonder whether the institutions they relied on were as strong as they appeared. As the unease grew, banks tightened lending, hoping to protect themselves from the unknown. But this caution only fed the public's fears. Merchants struggled to secure credit. Families rushed to withdraw savings. Trains filled with anxious travelers heading to city centers to retrieve their deposits before it was too late. The country had seen financial turbulence before, but this time felt different. This time, the fear itself was accelerating the crisis. Yet even in these early hours, there were signs that the panic had deeper roots. Economic expansion had pushed banks to the edge, encouraging risky loans and speculative investments. When the slightest shock arrived, the system reacted with a force far beyond what anyone expected. The nation stood on the edge of a breaking point, unsure which way the tide would turn. These first beats set the stage for what will become one of the defining financial tremors of the century, a moment when trust faltered, institutions stumbled, and the United States was forced to confront the true fragility of its expanding financial world. The hesitation that marked the panic's beginning soon widened into a measurable strain, touching every corner of the financial system. Banks that had once promised steady support now found themselves scrambling to preserve liquidity. Their vaults seemed smaller by the hour as depositors lined up, each person convinced they needed to act before someone else did. The fear became self-fulfilling, and the institutions meant to inspire confidence were suddenly symbols of fragility. Inside boardrooms, decisions grew increasingly desperate. Executives reviewed ledgers late into the night, debating how much gold or currency they could release without risking collapse. Letters flew across state lines, urging allies to send support or extend credit. But cooperation faltered under pressure. Each institution wanted reassurance, yet few were willing to provide it. What began as a collective system now fractured into isolated fortresses, each fighting for survival. Merchants felt the tightening grip almost immediately. Supplies that once moved freely were delayed or halted as trade partners hesitated to extend credit. Warehouses filled with goods that could not be sold because nobody could guarantee payment. The economic engine that had powered so much growth now sputtered with inconsistency, as every part of the system waited for clarity that never came. Meanwhile, newspapers amplified the uncertainty. Reports of bank failures appeared beside editorials urging calm, creating a blend of hope and fear that only deepened public confusion. Rural communities, far from the financial centers, relied on rumors carried by travelers and aging telegraph lines. Each fragment of news added pressure, causing some towns to empty their savings entirely, while others clung to hope that local institutions might weather the storm. Political leaders soon realized the panic had outgrown simple explanations. Some blamed overly ambitious rail schemes. Others pointed to volatile commodity markets or loose banking oversight. But none of these arguments captured the full picture. Beneath the surface lay decades of unchecked expansion and a patchwork collection of banks operating without a unified safety net. The country had built a booming economy on interdependence, yet it never prepared for what might happen when fear spread faster than confidence. As the crisis deepened, whispers of failure turned into declarations. A few prominent banks closed their doors. Credit lines evaporated, and the shockwave sent families, businesses, and entire communities into a spiral of uncertainty. The nation braced itself, realizing that this was no longer a fleeting disturbance. It was the early stage of a storm with the power to reshape the foundations of American finance. The storm did not break all at once. It gathered strength in waves, each one exposing a new weakness in the nation's financial structure. As banks failed in one region, pressure mounted in the next, triggering a cascade that felt less like a series of isolated collapses and more like a single, unstoppable unraveling. Communities that believed they were insulated suddenly found their local institutions gasping for stability, forced to confront the reality that no part of the system existed on its own. Merchants who had weathered earlier downturns now faced empty shelves and unpaid invoices. Their customers, equally strained, tightened their spending. Shops once filled with steady conversation fell silent as owners calculated how long they could survive without reliable credit. Families who had built their lives on modest security watched their savings shrink with every new headline. The panic had become a shared experience, spreading across borders and currencies, binding the nation in collective uncertainty. Railroads, symbols of progress and ambition, became unexpected flashpoints. Many had relied on aggressive financing to stretch across vast distances, connecting cities and industries with unprecedented speed. But those same financial structures now cracked under pressure. Investors pulled back, construction halted, workers were sent home with little warning. The collapse of even a single railway line sent ripples into mining towns, agricultural hubs, and ports that depended on predictable movement of goods. What had once been a triumph of American ingenuity now exposed the dangers of expansion without safeguards. Inside government halls, frustration simmered. Officials debated whether to intervene or allow the system to correct itself. Some feared that action would signal favoritism toward powerful banks. Others argued that inaction would deepen the crisis. The debates grew sharper as the consequences became impossible to ignore. Every delayed decision added momentum to the spiral, turning political disagreement into an invisible force pulling the country further into distress. Public anger grew alongside public fear. Crowds gathered outside closed bank doors, demanding explanations. Newspapers printed stories of mismanagement and speculation, adding fuel to the fire. The divide between wealthy investors and everyday citizens widened as people questioned who truly bore responsibility for the unraveling. For many, the panic was not merely a financial event. It was a betrayal of trust, a moment when the system revealed its deepest vulnerabilities. And yet, amid the fractures, small acts of resilience emerged. Communities organized local lending circles. Merchants extended credit based on reputation, rather than formal guarantees. These efforts could not stop the broader collapse, but they offered brief pockets of stability in an unpredictable landscape. Still, even these gestures could not shield the country from the mounting realization. The crisis was no longer simply about bank failures. It had become a defining test of the nation's ability to adapt, respond, and endure a challenge it had never fully anticipated. The tension now stretched across every sector, every household. The panic was no longer building. It was approaching its decisive moment, when a fragile balance between fear and survival would finally break. The breaking point arrived quietly at first, then with unmistakable force. A major institution, once considered untouchable, closed its doors without warning. The announcement rippled outward, carrying a shock that reached far beyond its immediate customers. Confidence, already fragile, shattered. What had begun as scattered doubts transformed into a nationwide reckoning, revealing just how quickly a financial system built on trust could collapse when that trust evaporated. In the days that followed, the nation found itself stripped of illusion. Rail projects stalled indefinitely. Businesses that had anchored their communities shuttered with heartbreaking speed. Households faced impossible choices as savings vanished. The panic exposed not only the structural flaws within the banking landscape, but also the absence of a unified authority capable of coordinating a response. Every state, every institution, every leader seemed to be fighting the storm alone. Yet it was in this moment of profound vulnerability that a new understanding began to take shape. Political leaders, once divided, recognized that the country could no longer rely on patchwork systems and regional solutions. Economists who had warned of the dangers of unregulated expansion suddenly found their voices amplified. Even ordinary citizens sensed that the chaos was revealing something essential, the need for a more cohesive framework, one capable of absorbing shocks rather than collapsing under them. Relief efforts emerged slowly. Temporary credit arrangements were patched together. Informal agreements kept essential trade moving just enough to prevent total shutdown. And gradually, as the immediate panic eased, the nation began to reflect on what had happened and why. The crisis was devastating, but it was also clarifying. It showed that growth without safeguards carried hidden costs. It revealed that ambition, when untethered from responsibility, could destabilize even the strongest institutions. And it forced the country to confront the uncomfortable truth that without structural reform, another storm was inevitable. In time, these lessons would guide discussions that reshaped the foundation of American finance. New proposals for centralized support, early frameworks that hinted at the system the nation would one day build. The panic became more than a moment of collapse. It became the catalyst for a future defined by greater coordination and more deliberate planning. Looking back, the crisis stands as a stark reminder that progress often emerges from upheaval, that the moments which test a nation most deeply can also illuminate the path forward, and that trust, once broken, demands not just repair but reinvention. Sometimes the smallest shift in perspective becomes the beginning of a new future.